Okay, so Warren Buffett just sent Wall Street what has got to be one of the most confusing and, frankly, anxiety-inducing signals of 2026. I mean, for years now, we've all watched the Oracle of Omaha just sit on this absolute mountain of cash while the rest of the stock market kept climbing higher and higher, right? Well, welcome to today's Explainer. We are going to unpack the whole mystery behind Berkshire Hathaway's massive cash hoarding, figure out what it actually means for the market, and most importantly, how we can use Buffett's latest moves to analyze our very own portfolios. Let's get right into it.
All right, to really understand why investors got so spooked, we need to look at the numbers. For roughly 14 consecutive quarters, 14, Berkshire Hathaway was a net seller of stocks. So for over 3 years, they were consistently pulling back, reducing their equity exposure instead of deploying that capital. And over that time, the difference between what they sold and what they bought grew to a staggering $175 billion. Think about that for a second. When the greatest investor of all time sells $175 billion more in stock than he buys, yeah, people are going to notice.
And naturally, that level of unprecedented selling sparked a terrifying question. You could literally hear it echoing across trading floors and all over the financial media. Is Warren Buffett preparing for a market crash? I mean, on the surface, it absolutely looked like he was bracing for disaster.
But then we get to the end of the second quarter, and there is a massive plot twist. At the end of Q1 2026, Berkshire's cash pile was sitting at a record $380 billion. But by June 30th, it had actually dropped down to about $365 billion. Why? Well, because Buffett finally started putting that money to work. In Q2, for the first time in over 3 years, Berkshire actually became a net buyer of stocks again. They picked up roughly $19.8 billion in equities and bought back about $4.5 billion of their own Berkshire shares. Now, if you spend any time scrolling YouTube or reading financial news, you've no doubt seen those alarming, clickbaity headlines screaming, "Buffett warns of crash." But honestly, that is incredibly misleading. The reality is vastly different. A much more accurate way to look at it is simply this. Berkshire has become selective again. Yes, that massive cash position absolutely shows he's being cautious. But the fact that he's a net buyer again, that proves this is not some giant signal to sell everything and run for the hills. It's just a signal to buy selectively, when both the price and the business actually make sense. So what exactly is he buying? Let's jump into part 1, the massive Alphabet bet, and take a look at Berkshire's new position. Berkshire didn't just throw that capital at a random assortment of stocks. They made a highly calculated, massive move into big tech, dropping an astonishing $17 billion into Alphabet during the second quarter alone. They scooped up approximately 48.1 million shares, which brought their total stake to roughly 106 million shares. By the end of June, that position was worth nearly $37.8 billion. So yeah, Google's parent company, Alphabet, is now officially Berkshire's third largest equity holding. Crazy, right? Now, for years, Buffett was notoriously cautious about tech stocks. He always said he didn't quite grasp their durable advantages. But Alphabet? It actually fits the modern Berkshire mold perfectly because of its absolutely impenetrable competitive advantages. We aren't just talking about them dominating global search here. It's the whole interconnected ecosystem. You've got YouTube, Google Cloud, digital advertising, and of course, their incredibly aggressive push into AI. And what's genuinely fascinating about this is that Berkshire had actually already agreed to invest about $10 billion in Alphabet completely separately. Alphabet has laid out this enormous spending plan, setting aside roughly $80 billion just for AI infrastructure in 2026 alone. So Berkshire's massive bet isn't just a simple play on people Googling things. It is a highly calculated bet on the massive physical infrastructure required to power the entire future of artificial intelligence. Which brings us to probably the most important question surrounding this whole AI boom. See, the big question isn't just who has the best AI model. Everyone is fighting that battle. The bigger, much more lucrative question is who can turn AI into enormous, durable cash flows. Alphabet has multiple proven ways to actually monetize this tech at scale. So Berkshire's massive investment here really suggests that Buffett and his team see this incredibly attractive combination of technology, scale, and most importantly for them, actual cash generation. But there is a flip side to this. Let's move to part 2, the real market warning, and talk about valuation risk. See, while Buffett was out there buying up Alphabet, he was simultaneously giving the rest of the market a very quiet but very stern warning. The real warning isn't that some massive crash is happening tomorrow. It's about valuation risk. The core lesson here? Don't confuse a rising market with a cheap market. That distinction is absolutely vital. You can find an outstanding, world-changing company, but it can still end up being a terrible investment if you pay too high a price for it. Ultimately, the price you pay today strictly determines your future return. And to prove that Buffett's overall strategy here is fundamentally about finding value and not just some tech-driven panic buy, we just have to look at what else they were buying. Berkshire really broadened the net. They upped their investments in areas completely outside of Silicon Valley. We're talking home builders, Delta Airlines, Macy's. They even completed the acquisition of Taylor Morrison. It's honestly a masterclass in selective positioning. They're finding these little pockets of value across really diverse sectors while still keeping a cautious stance on the broader overall market. All right, let's apply this to the rest of the tech world in part 3, grading the AI stocks. Buy, watch, or wait. So how exactly do we apply this strict valuation warning to the broader AI landscape? Well, we have to start with the undisputed heavyweight of the AI boom, right? NVIDIA. Look, asking if NVIDIA is a great company is the easy part. Of course it is. They've got massive upcoming catalysts, like the Blackwell rollout, the next-gen Vera Rubin platform, huge opportunities in China. But applying Buffett's lesson, we have to ask a much harder question. At today's sky-high valuation, are their future earnings truly large enough to justify the price it's sitting at today? When expectations get this high, even an incredible business faces severe earnings event risk, meaning if they miss their projections by even a tiny fraction, the stock decline can be absolutely brutal. And if we look at the rest of the AI landscape, we see a lot of similar stories. Exceptional businesses for sure, but you've got to be super careful with valuation. Take Microsoft, an exceptional business with massive AI and cloud exposure. That's definitely a buyer watch. Amazon gives you AWS, AI infrastructure, and a booming ad segment. Also a buyer watch. Broadcom is this major AI custom chip story, but again, valuation and financing expectations matter heavily there. The upside on AI is massive, but since current prices are often baking in years of absolute perfection, the risk is massive too. Also, while everyone is getting distracted by these high-flying AI stocks, do not ignore what we call the dividend defenders. Historically, Buffett's portfolio has been firmly anchored on businesses like Apple, American Express, Coca-Cola, and Chevron. Now, these might not be the fastest-growing, super flashy tech disruptors, but they provide this phenomenal combination of reliable cash flow, deep competitive advantages, steady dividends, and long-term durability. When growth valuations across the broader market start looking stretched, these cash-generating machines become your portfolio's absolute best defense. So, how can you do this yourself? That brings us to part 4, your 5-step framework. Let's learn how to analyze like Buffett. Instead of just trying to blindly copy Buffett's trades weeks after he actually makes them, we can pull a 5-step framework directly from his latest moves and use it for ourselves. Step 1, strong business. Does the company have a durable competitive advantage? Step 2, earnings growth. Are revenues and earnings actually expanding right now, or is it just promised for someday in the future? Step 3, acceptable valuation. Are the market's expectations already way too high? Step 4, positive catalyst. What specific event is actually going to drive the stock higher? And finally, step 5, reasonable risk. What could completely destroy this investment thesis? If a stock scores well on all 5 of those, it's a buy or a watch. But if it's a fantastic business where the valuation is just completely extreme, Ultimately, the biggest takeaway from Buffett's massive $365 billion cash pile is brilliantly simple. Cash gives you patience. Liquidity is essentially a superpower. When the rest of the market is euphoric and chasing unproven trends, having cash means you don't have to chase. And when everyone is terrified and panic selling everything, you don't have to panic either. You get to sit back, analyze the data, and just wait for a really great business to finally hit an attractive price. Buffett's massive bet on Alphabet proves that real opportunities still exist, even in a very expensive market. He didn't retreat entirely, he just got highly selective. So, as you look at your own portfolio and try to navigate this totally fascinating market environment, I want to leave you with this final provocative thought. Applying that 5-step framework we just went over, which companies do you believe are genuinely still worth buying at today's price? Until next time, keep analyzing, stay patient, and thanks for joining me on this explainer.